Welcome to Bullshift the podcast, where we talk about behavioral finance with regard to the way people make their investing decisions. And there's a specific focus here we do at Bullshift, and that is we look at optimism bias and we look at how the financial services industry shifts your attention to make you feel more bullish. My name is John DeGuy. I am the author of the book Bullshift and the host of the podcast. My guest this week is Robert Stel. Robert is the Vice President at Environics Research in Canada. He holds an MBA and has a great deal of background with regard to being a subject matter expert in the financial services industry, which is where he has a specialization. Robert, welcome.
Thanks very much, Sean. Nice to be here.
Yeah, it's great having you on, and I have such high regard for the people at Environics and the work they do with regard to attitudes and the way you do research, not only with regard to public policy but also just perceptions of things. And there's a lot that people need to think about in terms of how financial advisors are perceived, what they do, and what they can do differently and what they can do better, I suppose, in particular. And there are lots of little sort of rabbit holes that you can go down. And one of the rabbit holes that I wanted to talk to you about is ESG investing. Environmental, social, governance issues are the sorts of things that have become quite prominent in the past 5, 6, 8 years. I'm wondering if you could share your thoughts on how people perceive ESG investing in general and what the trends are.
Ooh, start with a big question.
Okay.
Uh, it's a good one. It's a very interesting topic, one that I have a lot of personal information in. You mentioned my MBA. And years ago, I was completing my MBA. Many more years than I'd like to admit, before my adult children were born. Um, and you have to pick a topic for that kind of project, obviously, and do a research project to complete. So I was driving one night listening to the radio on my way home and came across a very interesting discussion on how people integrate ethics into buying behavior. And in particular, it was after I think one of the major shoe manufacturers had made some serious mistakes overseas. And the reality was a lot of people were very surprised that this type of thing could happen, and it made a lot of people at the time really think about and talk about how they were buying things and the impact of our consumer choices. So it was a really interesting conversation. Got me very hooked on it, and I ended up doing a study where basically we did a large scale survey project. What for I guess a student project is a large scale project. We've certainly done larger since then, but and really looked into, for people who are buying running shoes, how do they integrate ethics into other buying and consumer behavior decisions? So it was a very interesting conversation. We learned a lot about it, and I've kind of been looking at that category ever since. And what's really interesting to me is a lot of the things hold true now that did back then, right? Or that we saw back then. And it's a very interesting topic to look at, but a really big topic. When it comes to ESG, I think what's really interesting and what's really most important to understand right now is that typically, especially where the advisor conversation is concerned, advisors tend to be fairly skeptical of ESG. They're a little bit concerned. They know that, particularly in the current environment, clients and particularly the higher asset clients that they're most interested in attracting to their practices are very concerned with returns and are looking for their advisors to provide solid advice that produces results. So because of that, when it comes to ESG, in many cases, it's a new area for advisors. It's an emerging area. It's one with a fairly large number of pitfalls, high client expectations, and more. Advisors tend to be fairly slow to adopt. And when you look at it, at kind of the flip side of that, their clients, consumers, tend to very strongly embrace ESG.
So that's interesting because I know a lot of institutions, certainly a lot of universities and foundations and pension funds have sort of jumped in with both feet with regard to ESG investing and have done that for some time. And that's certainly been my experience as well, that a lot of consumers are on board as well. Why would you why would you surmise, if you know, I'd be happy to know, but if you don't know, maybe you can maybe guess as to why advisors have been so slow to adapt?
Well, I think a lot of it does come down to this concern that they have about, their clients' demands on them, the expectation that they will help their clients to produce superior results. In many cases, when advisors talk about ESG or ESG brands, when it comes to investment manufacturers, they've seen disappointment in the past. And when it comes to the consumer conversations, they're also quite difficult, quite challenging, right? So frequently, when you talk to consumer investors about, their expectations, we find that they are frequently very interested in ESG. They really like the idea. They want to do good in their lives in general, certainly in how they consume and spend. Investing is no different. But when you get down to what that means, I think there's still a lot of misunderstanding, right? So those conversations can be very difficult, right? What does it mean when you set your client up with some very good quality investment products? And then in a year, your client comes back to you and says, "Hey, wait a second. Why do I have oil and gas in my portfolio despite it being an ESG portfolio? Why do I have mining in there or other products or brands that I'm concerned about?" And of course, that's a much broader conversation, and there's a lot more going on there. But it can be a very challenging conversation, and if you don't have that conversation thoroughly and upfront with clients, it can lead to a lot of disappointment.
A lot of what I have heard is that advisors, especially in speaking with other people who do what I do for a living, I'm a portfolio manager, they'll say that they try to get into their clients' heads and they want to be able to reflect their clients' values. If the clients' values are one of being concerned about social governments, corporate governments, for instance, then it would only make sense that you would be able to give them investment products and solutions that would reflect that ethos. Yet there's a concern that you've touched on already that there's some people who think that doing that will somehow compromise returns. Now, I'm of the view that there's no compelling evidence that returns are higher or lower. But let me push back on the logic here and see what you think about this. If one honestly believes that being an ESG investor will hurt returns, then that implies that investing in sin products, armaments, liquor, tobacco, what have you, and not having multi-voting shares and having all male boards and questionable governance and ethics and whatnot, those are the sorts of things that, if the logic holds, will lead to outperformance. Because if you believe that watching for these things will make your performance be worse, then embracing them, the logic would follow, would make your performance better. Now, I think that's ridiculous, but I'm wondering if you've come across anyone who actually does the jujitsu of the logic of what they're saying and thinking of the flip side of what they've said to their clients.
Yeah, I mean it's a real challenge right now. I guess I have the luxury as a researcher of not necessarily dealing in facts. I deal in people's opinions, and whether they're right or wrong, their opinions are the reality for what advisors and marketers and entire industries have to deal with. So, I mean, and right now, I think we are seeing a lot of backlash against ESG, or a lot. I would say it's a very small part of the population where we're seeing that, right? You've probably heard terms like "go woke, go broke," stuff like that. It's being politicized, weaponized. I think even in some cases um, to really create a bit of a consumer backlash. But at the same time, the reality is that most people, by far the majority, um, want the companies that they work with to reflect their values, see this as important, and see an opportunity to do good here. The question is, and I think the problem is a little bit more that, I mean, realistically, what does that mean? The industry itself, in many ways, doesn't know, and is, well, many people in the industry know, but there isn't necessarily that consensus, right? I mean, do we does ESG investing mean investing in, uh, um, does it mean investing in electric vehicles? If so, does it mean investing in mining, right? You can't have one without the other. Um, so that creates, I think, a level of challenging communications as well, and a level of nuance. And the other challenge here is that there's a bit of a paradox when it comes to ethical consumerism in general, which is that way back in the day when I did the running shoe project, what we found really quickly is, the hypothesis was that people for whom running shoes were a very high involvement purchase, so runners, athletes, these kinds of people, would also be very interested in knowing that their shoes were of the highest quality and that that would mean an ethical component. And what we found was kind of the opposite. So consumers, when they were buying running shoes, if they needed it for the orthopedic component, they were likely less interested in an ethical component, right?
Wow.
So you wanted a shoe that would protect your knees or help you avoid ankle pain and things like that. And at the time, the ethics of how the shoe was made was very secondary to that consideration. It wasn't unimportant. It wasn't that it didn't matter. It certainly was not paramount for these people, right? And that makes sense if that's your goal. And we see a bit of a similar problem when it comes to investing, right? We see quite a lot of engagement when it comes to people who are interested in ESG investing or any of the components that are included in that. But especially, we see higher levels of interest among those who are less interested or less engaged as investors in general. And often you see a little bit of a paradox, right? Many people who are wealthier, are more engaged with their investments, have more savings, um, and are more involved, tend to be more interested in the returns and kind of that bottom line efficacy. So it's not even that there's always a question of one versus the other. It's more a question of where does it fit, right? You take somebody who, for example, is at a late stage in their career, is nearing retirement, and they may well be interested in ESG, right? Often people assume that this is all younger people, but I like to remind people that it was the baby boomer generation who invented the environmental movement. So there's a lot of interest there. But when you're nearing retirement and you have to start trading off these things potentially, that's where these kinds of messages can be very harmful. Um, so
It's
whether
interesting.
people believe it or not can vary, but if they do believe it or they do see any credibility in it, or even just are fearful that it might be true, it can cause some real issues.
Wow. The thing that I notice is, and speaking with you, but also with other guests on the podcast, is that human decision making is a complex, multifaceted, not at all intuitive process, which is to say, sometimes you get from A to D, but it's not necessarily A to B and B to C and then C to D. The way we get to where we get can oftentimes be convoluted and not at all obvious and not at all intuitive. And it's funny because you're the person who does the research to actually figure out how people make their decisions and why they make them. And a lot of the things that you unearth are counterintuitive. And some of the things you've shared already have already got me going, wow, I wouldn't have expected that. What about men and women? Can you perhaps share some thoughts about the way men make decisions or what men tend to focus on when they make financial decisions and what women focus on and are either of them any more optimistic than the other?
Oh, that is a very interesting, also very muddy conversation as well. Yeah,
Okay.
I mean that is one of the wonderful things about what I do, right? We do create these wonderful models where we try to create predictive models for how people make decisions as consumers, as investors, as individuals, and it is a fascinating topic. And one of the founding fathers of a guy named George Box of model building for decision making has a saying that all models are broken, some models are useful. Right. So what we're trying to do is understand this stuff at a level where it's helpful. And we've looked for years. My colleague Kate Moreau and I have found it really interesting to look at this. Right, we know that there's a lot of demographic changes coming up. In many ways, the world has seen investing as a blue task historically, right? It's mostly males that are making the decisions, engaged. But of course, demographic shifts over generations are really changing behavior, outlooks, approach. And it's been very interesting to look at not only how that is emerging, but also how the industry is responding to these things. And we've seen a lot come out. You've probably seen the statistic over the last couple of years that 80% of women change advisors upon the death of a spouse. That one is everywhere in our industry. And as near as we can tell, it has no basis in truth or research whatsoever. I really wish our industry would stop talking about that statistic because I don't believe it.
It's another example of bullshit. It's just one of those things that they say that's just it sounds right, but it just ain't.
It resonates, right? It sounds like it's got to have some basis in the truth, and we hear a lot of other things that come up as well, right? There are some differences. And this is where, even as a survey researcher, I would say potentially survey research has its limitations as well, right? We go out and we survey a huge number of women and men who are investors, and we see differences emerging, right? We see a gap in confidence. Uh, we see a gap in terms of expectations, people's belief in their own ability to navigate or manage their investments, appetite for additional education, these kinds of things. Um, and then the industry responds to these things, right? We respond by coming up with tailored educational programs for women versus men as investors, and what makes the difference. And the problem is, I think a lot of this stuff, kind of gets back to some of the gendered marketing that takes place over a lot of different industries. Just because you can doesn't mean you should. And in general, when it comes down to it, we are seeing a lot of shifts, right? I mean, obviously, we know that women are much more likely to be finishing higher levels of education. We've seen that for decades. It's making a big change. The wealth gap persists, right? So there's all of these differences that probably lead into these differences in understanding, knowledgeability, expectation, all of these different things that companies are marketing to. The challenge is, though, in the end, when you talk to investors, the number one thing that people want is to be treated the same. And I think that creates some real problems for some of these efforts, right? And from our perspective, I would say what's really come out as important when we talk to individual investors and we try to get their perspectives on it is, look, as an advisor, you still need to really have the conversations. You need to understand my needs. You need to understand where I'm at. There likely is a long list of different things that advisors need to look at as a starting point, including things like wealth gaps, including things like educational differences, increasingly differences in upward mobility for women versus men, and different career paths. Right, all of these things become important. But also, in the face of a generation where we're seeing some big differences as well. People aren't coming out and being taught by likely a father figure that as you start your career, you need to start investing right away and start putting away money for retirement. I started. I had a paper route, and I put money from that paper route into retirement savings, as I was encouraged to by my small business owning parents. Right, but now it's tougher. It's a different challenge, right? When it comes to paying for school, when it comes to saving for a house, when it comes to where do relationships fit in the midst of this, and what do these more modern gender differences look like as well, right? In terms of people pursuing education versus increasingly well, actually, I'd say persistently trades being a very male pursuit as well. So there are big differences because of that, in terms of when people start their earning abilities or grow their earnings, and what it looks like in terms of savings and those challenges too, right? So that kind of all layers on.
Right. I was going to say
Go ahead.
I was going to say there's also I've seen a lot of people say that there's research that shows that women are generally better clients, and again that's very broad brushstrokes, because they're less prone to overconfidence. Overconfidence is a male attribute that is more of a problem, and so the men think they're bulletproof. They take on more risks than they realize they're taking, and as a result, when things go less well, they A, experience a bigger drawdown, and B, are more impatient in waiting for it to recover, and as a result are inclined to do things that are more emotional and knee jerk, as opposed to the women that are sort of the tortoise that wins the race in many instances.
Yeah, and it's really interesting to think about like what does that look like, right? I mean, if you're, I've we've done some large scale studies where we've done very interesting conversations with investors at all kinds of different stages of their investment journey. And one of the common stories that we've seen over and over is, like young male starts out investing, gets a great job working, in the oil patch or something like that. But they're young, they're making great money, have all of these opportunities, and what do? They decide to take on day trading or some kind of DIY investing, and they're basically out picking stocks. And then, if you talk to them at the time, they sound very confident. And frequently, you talk to them years later, and the smarter ones at least seem to get to the point where they look back and go, "Yeah, that was a mistake." And if I was honest with myself, and I looked at the losses relative to the wins, yes, the wins were exciting, but I lost more than I gained. Um, I'm not really sure though, and this gets back to what I was saying earlier, how much of that is a gender difference versus, age versus income, women kind of generating stronger earning power, but later in life in many cases. And I would say increasingly as we move forward, and that's what the future increasingly seems to look like, which is a very interesting opportunity, right? I think there's a lot of statistics that support the idea that in the future, the key decision makers in the household, key decision makers over finances, and in many ways, key wage earners are going to be female. This will probably be heavily impacted by the great wealth transfer coming up. And the real question is, how do we deal with this? And one of the frustrations that we've had often in looking at this industry is that the flip side of the industry is persistently male and aging. And that's, from the point of view of the women that we speak to as investors, they don't see this as problematic at all, right? When you ask, do you prefer your advisor to be male, female? We see men who prefer their investment advisor to be uh, either, but generally speaking, it's pretty balanced. And women mostly tend to be the same. What's really important is that the person is tenured, understands what they're doing, and has the ability to understand my needs. Right? So I think the challenge increasingly moving forward is going to be just simply, can you have those conversations? Do you understand the challenges that various investors face? And are you able to help them through that process in a way that feels comfortable and natural for them? Undoubtedly, in an industry that is, I think, generally about 20% female, there needs to be some change and some more balance. And there's probably a wide range of reasons why the industry has persisted that way. But from the perspective again of what we're trying to do, I think the conversations need to remain, and the crux really needs to be that those are solid conversations, that people feel listened to, understood, and well served. And that's really the crux. And a lot of the other differences that come out of it seem to be more related to either cultural expectations or demographic shifts that have been happening over absolutely generations.
What would you say are the primary needs and challenges for the financial services industry in the near term? Let's say in the next 5 to 10 years.
Uh, Always the big questions, John.
Well,
I mean, there's a lot of challenges, obviously. Especially, I mean, the wealth transfer, I think, is going to potentially be very transformational. I think a lot of thinking is going into um, the approach there and how that'll be dealt with. But I think the corresponding challenge to that is also one of really kind of looking at the nature of advisor practices as well. Again, we're seeing an aging demographic. We're seeing it as in some ways, a bit of an industry created problem where getting into that line of work has been difficult for younger people. It's been difficult for, attracting especially women to the industry. and essentially coming up with a mix in the industry that is representative of the people that are being served. One of the challenges that we've really seen in that as well, that kind of corresponds with it, is an advisors as a group that are focusing very heavily on attracting increasingly affluent clients, right? Because that's where you want to be when you're an advisor. It takes less effort to work with those clients in general. They're more demanding clients, but you're dealing with a smaller number of them and can provide a higher level of support. So trying to attract increasingly affluent clients and ideally in an increasingly smaller number, so fewer clients, greater assets. But what that's meant is, of course, because of the nature of how assets are distributed, right? You make your money as you get older. That means that advisors increasingly are dealing with older clients as well. And essentially, the whole industry is kind of shifting northward in terms of both age and assets. And so the question that leaves us with is what's going to happen with younger investors? And the answer is typically that they've kind of come up through working with their bank, but they haven't always been that well served there. And, they haven't always made the transition to an advisor that way either. So they may not be getting that level of advice, and layer on increasing challenges as well, which kind of work or kind of translate across generations. But challenges with things like misunderstanding of risk, further to your point, but also looking at that in terms of a lot of the fraud that's becoming more and more rampant in the industry, a growing number of risky alternative investments, so things like cryptocurrency, and you see a lot of people that are hurting themselves, especially at those early stages, right? And that happens in one of two ways, right? Because we talk about gender differences as well, um, and those are absolutely not uniform across investors, right? But you talk about, I think that the stereotypical young male that is way too aggressive in terms of what they're doing and takes a lot of loss because of it, but also in terms of investors that are kind of the opposite of that, whether they're uh, uh, men, women, or whatever, but that are too conservative with their money and are not saving early enough and are not planning. And I think some of these stories we frequently hear kind of filtering into this as well, right? I had a friend who was invested in cryptocurrency or risky stocks or stuff like that, lost all of it, and now what should I do? So, we definitely see investors making mistakes on both sides of the equation, whether being too bullish or too conservative.
Right. Okay. All right. This brings us to the end here, where we're going to ask you to talk about something that might be stuck in your craw. Is there anything that, as we get to the segment that I call "That's Bullshit," what is there in the industry that you think is not always on the up and up that you think could be improved upon?
I would say that um, the biggest concern really is kind of this question of what is the next generation of investors going to look like? How are
Yeah.
we working with them, and are we leaving them in the lurch? Right. Increasingly, I think we're seeing generations with much more complex needs that are not coming up, that are not starting investing early on in their careers, that are forced to look at a wider range of different financial needs. And as a result, as they're coming up, right, unless they have wealthy parents or some other reason to be connecting with an advisor or good quality advice, are being kind of left behind by the industry. And I think there's some
Okay.
real questions about, how can we continue to serve them, and how can we continue to manage their needs and make sure that they succeed, right? And case in point, I think would be looking at coming out of COVID, where a lot of these investors, saw a challenge. A lot of them saw their priorities being rearranged in terms of where they want that work-life balance to be, and increasingly are kind of moving away from the savings patterns you would like to see among younger Canadians, living more in debt and potentially causing greater challenges for themselves farther down the road.
Okay. So
And it's a
that
concern,
then
right? We talk about K-shaped recovery, but this
right.
is going to be part and parcel of the same issue.
That then brings us to the second half, which is shift happens. If it was up to you, what would you do to help these younger people who are having a difficult time finding their way in their life, but also getting access to proper advice given their career path and the complexities of 2023. How would you help those people along and help them to find their own financial journey?
Um, I think the answer to it is going to be a mass media approach and some solid communication and education programs. I think the challenge that we've seen over the last couple of years in the explosion of social media, the entire internet age, which sometimes I think feels more mature to us than it actually is just this people being inundated by information and not knowing where to turn for good quality advice when it comes to particularly managing finances, right? And again, layer on these additional challenges, and it becomes very problematic. But ideally, the same kinds of things that are the challenge for people are causing the challenge would be part of the solution, right? So there's a great opportunity to leverage new media, different series. There's a lot of good stuff out there, but it would be great to see that standardized, developed, and ideally rolled out on even an industry-wide level at some point. But essentially, there needs to be more and better education of younger investors in terms of looking at what that means, looking at what standard approaches might look like, looking at ideas of how do you manage and talk about risk, and then really building on that understanding. Right? I think the conversations you have about risk are very important for people. But again, bearing in mind that from our perspective, we see people making pretty strong research, pretty strong errors on both sides of that equation, and really, particularly early on in their investment careers, needing to just understand the importance of saving, understanding the importance of planning, and understanding the importance of managing their finances well.
Great. I'll stop you there, Robert. I will comment that I will say that I've now done over 30 episodes of this podcast, and when I ask open-endedly for my guests to say, what's bugging you with regard to that's bullshit, and what would you do about it if a shift happens, literally about half of them, very close to half of them, say something that rhymes with investor education and starting young and helping young people get a better sense of their getting their bearings. It's really clear now that that is a consensus. And I talk to academics and consultants and practitioners and product manufacturers and all manner of different people, and yet that's the common theme, that no matter where you are, no matter what your entry point is to the financial services industry, there's a very strong consensus that what we need to do is we need to do a better job of educating the general public, and in particular young people, to get them up to a certain base level so that the mistakes that our parents made will not be repeated by our children.
So important. And often when you hear about people talking about this, it's kind of that older generation approach to, the world is falling apart and get off my lawn, kids, and all that kind of thing. Um, that's not the reality of it, though. This still remains important, right? Like, it's very easy to look at them and say, this generation is getting it all wrong. By and large, they're not getting it wrong, right? We're seeing stuff increasingly getting better. What we are seeing is a higher level of challenge, though. And I tell you, from my perspective, I would even look at it almost from the opposite direction of that, which is that, we've had some very interesting conversations with investors. We do this on an ongoing basis. And there is nothing that's harder to hear than an investor, and this happens way too often, than an investor in their 50s, 60s, or even beyond saying, if only I had known when I was younger. And that happens just way too much, and it's a sad thing to see where that a lot of investors turn it around, but certainly not all. So it definitely is important for people to just level set and understand what the opportunity is there.
Great. Robert, thank you so much. This has been a real pleasure. You're a wealth of knowledge, and I love the insights about how. See, I didn't think my questions were all that tough, but you thought they were tough. So it's good that what it shows me is that you think about some of these things very deeply in a way that other people might just think of them as being superficial. And I think it's great that when people can listen to you speak, they might think about things in a way that they might not have because they thought the answer was simple and clear and black and white. Whereas you're very good in what you do in your day job at filling in the shades of gray and getting people to think about variations and nuances that they otherwise might gloss over. So thank you so much.
Thanks, John. Enjoy the conversation.
John DeGooey is a portfolio manager in Toronto and the author of the book Bullshift: How Optimism Bias Threatens Your Finances. Bullshift is available online and in bookstores everywhere. The opinions expressed in this podcast should not be construed as investment advice. Bullshift, the podcast, is produced by TalkShoe, a division of IOTM.